One of the most important distinctions that I've firsthand experience with as a financial services professional and a banker with my small business clients is when they come in looking for capital, they're trying to figure out what type of capital do I need based on the problem or opportunity that I have. So I'm going to quickly in this video break down the distinction between term loans and lines of credit as the two most popular products. Business credit cards are their own category. SBA loans are some, a different category in their own direction. We're talking about bank level term loans and lines of credit. Quick distinctions, quick benefits. We're going to cover it in this video. This is JP from Blueprint for Prosperity. To all my pioneers, welcome back. To all my new viewers, welcome in. Let's get right into the content. So when it comes to your business term loans and your business lines of credit, you are looking at two relatively distant cousins, we'll call it. So when it comes to the business term loan, quick highlights are probably the most attractive features is going to be fixed terms, fixed rates. You're going to get a defined term, you're going to get a defined payment, and you're going to get a fixed interest rate. And in today's economy, a fixed interest rate is highly attractive on any lending product because interest rates are all over the place and they're usually all over the place going up. So having a fixed rate and a fixed term is very attractive. The caveat to this is you're going to have a payment on a full amount right out of the gate. 30 days later, you got a bill. So this is going to be most beneficial for you as a business owner if you have a direct investment in your business or expansion of your business that you have a predictable income coming from. If you know you're going to be able to get your hands on that term loan, you've already done the math to realize what it's going to cost you. And what you're going to put it in is going to bring you more money back than what it's costing you to acquire it, to borrow the money for it, to acquire that asset or expand the business in that way. That is where a term loan is going to shine. It's going to shine where you can assure yourself or have an extremely high probability that you're going to get the cash flow back really quickly and at or above what it's costing you. Or there's some appreciation coming from it. Something has to outweigh the weight of that term loan, the cost, because you're going to be stuck with it immediately and indefinitely until it's paid off. So that is where a term loan is going to shine. Your line of credit is going to shine in flexibility. So your term loan is going to shine in stability. The line of credit is going to shine in flexibility. This is where this kicks into play. A business line of credit is going to be a flexible product that's going to have somewhat of a defined term in the sense that it might be, 120 months, or it could be 20 years, 10 years, 20 years, whatever the case may be. But it's going to have the flexibility of giving you access to a full lump sum of money and only charging you for what you use. That's number one. Number two, flexible payments. Most lines of credit will allow you to do interest-only payments for some extended period of time. That's an amazing benefit from a flexibility point of view. This is going to kick into play when you're investing in something that maybe isn't going to immediately give you that cash flow, or you're just stretching cash flow for something until invoices come in. Or, this is great if you're going to do maybe fix and flip in real estate. Lines of credit can be really attractive for that kind of thing. Another reason why they could be so attractive is because they revolve. You can pay them off and reuse them within that given term. So that money stays accessible. When you have a term loan, you get that lump sum of money, you get an immediate payment, immediate fixed term, and that money's due when it's due. And you're not getting a redo on it. It's paid, it's done, and you're gonna have to start over. When you're getting a line of credit, it's revolving. So that means fix and flipping, just as an example, is a great opportunity for that, because typically the concept is you're going to get the liquidity you need and the capital you need to take down a property, renovate it, fix it up, get it on the market, sell it, take a profit, pay that debt off, pocket some money, hopefully, and take that same money and go back out to the next property without having to redo any type of underwriting or applying for anything else within that given term. So the other caveat is you're going to usually have a variable rate. It's not common to have a fixed rate on a line of credit. And in today's environment, as we discussed at the time of this recording, rates are higher and they're fluid. So just in the last year, the prime rate has gone up over 5% from the federal funds rate, which has pushed, rates for banks up well into the double digits on lines of credit. So that means that whatever you're using this line of credit for, you got flexible payments, you got the rinse and repeat dynamic to this, but that interest is going to chew you up at some point in time if you don't have the cash flow or appreciation or that capital coming back from whatever it is you're using that line for. You have to be very careful about making sure that, yes, it's not going to cost me that fixed payment amount. I don't have to worry about the principal right now. But that interest over time is going to make you need really sizable profits for it to make mathematical sense, if you follow what I'm saying. So they both have their benefits, but your line of credit and your term loan, again, are two distant cousins. One is stable, fixed, predictable, and gonna hit you with a tab right out of the gate. And it's a one-time goal, it's one use. Your line of credit, rinse and repeat. Flexibility, flexible payment options. It's gonna have a flexible interest rate. And you also have the capability of that line of credit being shut down, frozen, chipped away at if something's going on with that institution, because it's an active pool of money. It's not gonna happen on an installment loan, on a term loan. So that's just some quick distinctions that I feel like would be very valuable for my small business owners who are getting into the business funding. If you're not in financial services, banking, or have a lot of personal experience with financial products, you don't really understand these little differences and nuances. So I'm hoping to bring that value to you in a relatively quick, straightforward video like this one. So if you have more questions or need more clarity, I want you guys to comment down below. I'd love to respond to you in the comments and give you more details or give you more clarity. Other than that, to all my pioneers, as I said, thank you for coming back in, and my new viewers, welcome in. Like the video, subscribe. There's going to be constant, consistent, daily content, quality, and straight to the point like this video was. Other than that, I want all of you to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.